Hello everyone, this video introduces the Japanese candlesticks techniques, popular since the 1990s, when the Western world embraced one of the simplest forms to analyse the market. And typically, most brokers nowadays provide different types of charts, bar charts, line charts, and candlestick charts. A candlestick, in technical analysis, looks like these red and green bars on the screen. This is the EURUSD 4-hour chart. Everything that we'll discuss during this video applies to any time frame, from the 5-minute to the monthly chart, with the distinction that the bigger the time frame is, the stronger the impact and the implications of the Japanese candlestick patterns. A candlestick has 3 different parts. Let's look at this one. The main part here is the real body, either green or red. And it reflects the distance the price travels from the opening of the candlestick to the closing price. Everything that's above is the upper shadow, and what's below is called the lower shadow. Therefore, both bullish, meaning green candlesticks, and bearish, meaning red candlesticks, may have either upper or a lower shadow, or both. The longer these are, the more the candlestick reflects uncertainty in the market. Now, the beauty of the Japanese candlestick pattern is that they're mostly reversal patterns. And secondly, the pattern takes a very little amount of time to form. Many patterns have only one candlestick. For instance, a candlestick that has a small real body and a long upper shadow and follows an upper trend is called a shooting star. It is the opposite of the hammer, which is the bullish pattern, and it only takes one candlestick for the market to reverse. So how can you trade it? Well, it's very easy. Wait for the market to close, always have a stop loss at the highs, measure the candlestick's length, and then project it to the downside 2 or 3 times to reach 1:2 or 1:3 risk-reward ratio. Another important pattern is the piercing pattern. It is formed out of 2 candlesticks, as you can see here. This is where one is bearish in the same direction of the main trend, and then the other one that reverses the previous candlestick and retraces 50% into the real body of the previous candlestick. This is enough for a long trade. Stop loss at the lows, measure the length of the pattern, and then project it to the upside. Other patterns, for instance, have 3 candlesticks. So take a look here. This is a bearish trend. One candlestick has a strong bearish real body, one with a small real body, and the third one that retraces 50% of the first candlestick. This is called the morning star, and it forms at the end of a bearish trend. And its opposite is called the evening star, forming at the end of a bullish trend. Similarly, the opposite of the piercing pattern is called dark cloud cover. These are only a few of the candlestick patterns that you can spot, but they offer important information to swing traders, investors, and scalpers, as depending on the time frame, the info plays an important role to the trading outcome. Another pattern are the bullish and bearish engulfing, when the second candlestick has a strong real body, you can see here, that engulfs the previous candlestick's real body, but it should not engulf the shadow. So this one is not valid as a bearish engulfing, as the second candlestick engulfs the lower shadow here. In order for the EURUSD to form a dark cloud cover, This second candlestick should retrace between 50% to 100% of the previous candlestick. For the EURUSD to form a bearish engulfing, the second candlestick must fully retrace the previous candlestick's real body, but not the shadow. For the market to form an evening star, then this candlestick's body should be really small when compared with the first one, and the third candlestick should retrace more than 50% of the first candlestick's body. That's it for this video. Thank you. Bye for now.